2024 is coming fast and we need to be ready for what it's going to bring to the housing market. Listen up to hear 5 things you need to know in order to prepare for 2024. Hey everyone, this is Wendy Pennell, and like it or not, we need to face the fact that monetary tightening probably isn't done and rates could still bounce back up from here. It's true the Fed has paused on raising rates, but that's because other events in the economy are doing the heavy lifting so the Fed doesn't have to. First of all, mortgage-backed securities and the secondary market are playing a huge role. The secondary mortgage market is like a marketplace where banks and other lenders sell their mortgages they've given to home buyers to investors. Now, when investors buy these mortgages, they're actually buying them in something called mortgage-backed securities. This helps lenders get more money to make new loans, and it kind of keeps mortgage rates in check. Government agencies like Fannie Mae, Freddie Mac, they also play a big role in this market. So picture it this way. Your mortgage is off, bundled up somewhere as a mortgage-backed security. And this is important, because this is what is wreaking havoc on interest rates. A big problem we're having is we don't have enough buyers in the secondary market. When a lender sells a mortgage, he needs to have a buyer, If there are no buyers, how will he get his money back in order to lend it again? We need buyers, and unfortunately, we're hurting for buyers, And here's why. When the Fed first decided to slow down inflation, they were honest from the very beginning in how they were going to do this, They were going to, number one, raise interest rates, right? And number two, shrink their balance sheet. Now, which of these, is everyone talking about? Well, obviously, we're all talking about raising rates, of course, right? But no one really talks about what it means for the Fed to shrink their balance sheet. And yet they've been doing this slowly, methodically, ever since they began raising interest rates. Tim Sablik from the Federal Reserve Bank of Richmond shares on this, saying how the Fed announced its plans for shrinking the balance sheet well in advance, and the QT process is happening passively following a fixed schedule. But what does all this have to do with the lack of buyers for mortgage-backed securities? Well, since COVID, the Fed was buying billions of dollars in these mortgage-backed securities. All right, so talk about there being buyers, lots of buyers in the market, right? The Fed was there just gobbling up those securities as fast as they were issued, right? And then guess what happened, Now the Fed stopped buying mortgage-backed securities. Shrinking their balance sheet means they aren't buying those mortgage-backed securities in mass volumes anymore. So boom, we have lost a major buyer. But never fear, right? There are other buyers in the secondary market, right? Well, think through how an investor makes money when they buy a mortgage-backed security. They make it through the interest on the debt. But when they buy the security, they have to pay all kinds of fees, right? And then closing costs, that sort of, if you look at it that way. And it takes a bit for them to recover those initial costs. The problem is the current buyers in the MBS market, they don't believe these mortgage-backed securities will last. The minute rates drop to 5%, homeowners will refinance, right? And can you blame them? I mean, isn't that what we're all hoping for? And as a result, mortgage rates have to go higher and higher in order to induce investors to buy. Investors want to recoup their money right off the bat, not recoup it over the long run, because they believe there won't be a long run, right? They think buyers will just refinance. This is also why you see lenders so willing to pay points to give you a lower rate, right? This allows them to make profit on their investment faster. So in the secondary market, you have the Fed no longer buying mortgage-backed securities in volume, and then you have investors sort of turning their nose up on it as well, right? So are you beginning to see how mortgage rates can go up without the Fed having to raise rates anymore? Right? They're accomplishing their goal through shrinking their balance sheet instead of raising rates. The process of shrinking their balance sheet takes more time, and it is more behind the scenes. Sablik comments on this too, saying this tightening through the liquidity channel may not show up immediately, but the fact is that it is happening. And you need to be aware that that tightening, it is still going on. Now, there is a whole other side to this we need to consider too. The second reason rates may still go up without the Fed raising them is through the bond market. Now, what do we know about bonds? Well, they're a safe market, It's not gonna be refinanced like a mortgage will, nor will its borrowers default, right? We're talking about the government here. So we've already established that if there's any hope for investors to invest in mortgage-backed securities, the rate will have to be higher, right? So mortgages have to offer a higher interest rate than bonds in order to induce investors. Well, guess what? Bonds have been going up too. So in addition to there being less demand for MBS already, now we have bonds that are driving them up as well. So you might be wondering why the interest rates on bonds are going up. Well, the Federal Reserve Bank answers for us, okay? They say the Treasury has stepped up bond issuance in recent months due to a growing federal government budget deficit. Basically, the government has so much debt that they're having to keep issuing more and more bonds. If you haven't caught on yet, this means we have a serious problem. The government has so much debt that they're issuing more and more bonds at the same time that the Fed has decided not to buy them. U.S. Wealth Management shares how they really didn't replace them by buying more. At the same time issuance is up, the Fed, as part of its monetary tightening policy, began allowing their large portfolio of U.S. Treasuries and mortgage-backed securities to mature. Once again, in order to induce investors to buy bonds when the market is being flooded by them, they have to raise the interest rates on mortgages, okay? Just listen to these numbers we got from U.S. Wealth Management. After spending most of the year below 4%, yields on the benchmark 10-year U.S. Treasury note began closing in on 5% by early October. Mertz continues, that means investors need to absorb growing Treasury supply, and to do so, they're demanding higher yields. The next thing you need to know heading into 2024 is both consumers and companies are running out of cash, and CPI should finally come down. For both consumers and companies, they've been able to live on built-up cash reserves. Even if income wasn't enough to cover expenses, it hasn't been showing up in, number one, consumer spending through CPI, and number two, company spending through job reports, right? Basically, them having to do or not do layoffs. Well, in the same way that it takes an economy as a whole to put on the brakes, it's hard for consumers as well, right? So like you personally, if you've gotten used to spending, used to eating out all the time, it can be hard to change that habit. So instead, you just switch over to living in debt instead. We can see how this has been happening with the all-time high of credit card debt. Marley J with NBC News says U.S. consumers took on $43 billion in additional credit card debt during the second quarter of this year, ending in June. She continues saying that's more than triple the average amount of new debt households have taken on in that period since after the Great Recession of 2007 to 2008. Did you catch that? Okay, more than triple. In addition, the number of refinances are also up. All right, now think about this. Why would anyone refinance at a 7.5% rate unless they were in financial difficulty and needed to do like a cash out refinance or maybe wrap in some expenses, right? Such as paying for an escrow shortage on a mortgage payment that just went way up. What we're seeing is a depletion of the financial cushion held by consumers. When interest rates were low, consumers had the opportunity to substantially increase their savings. For example, many would achieve this by means such as cash out refinancing. And during this time with rising home values and falling interest rates, the typical homeowner could engage in a cash out refinance, extracting like $100,000 in cash while hanging on to a similar monthly payment. I mean, that's what we did, okay? The old money pit here at Pinel Casa needed a facelift, so we did a cash out refinance. NBC News reports pandemic-era savings are largely spent down for most middle-income and lower-income households. Well, I love how this article from Fannie Mae puts it, okay? They say the pandemic-related fiscal transfers and built-up household savings have supported consumer spending longer than we had expected, providing unforeseen support to the macro economy. See, they're fully expecting a slight downturn during the first few months of 2024, predicated on the belief that consumers will begin pausing their spending, in part due to the exhaustion of those funds and having to realign to a more sustainable relationship between spending and incomes. Okay, we've talked a lot about consumers. Now let's talk about how companies are running out of cash reserves as well. Commercial loans aren't long-term like mortgages, right? They come due much sooner. So consider a company who has to refinance due to financial difficulty or just because their loan has come due. They're currently holding a 3% rate with their current loan, but now they're gonna have to refinance at like a 7.5% loan. Okay? You think that's gonna result in a tighter budget? You bet it will. Now, many of the major companies had plenty of time with rates near zero to raise cash at cheap rates so they could ride out the storm when the hiking cycle began. But many smaller and up-and-coming companies are running out of cash. Moving on, another thing to keep in mind is we're heading into an election year. Now, we know that election years mean uncertainty, but you have to wonder if they could also mean opportunity. Now, the Fed is supposed to operate independently of the government, but many have suggested that it'll look better for the current administration if rates go down. Regardless, you should know that an election year is a wild card. Forbes author Dima Williams states that research and industry experts agree that the closer the election gets, the more likely its effects on housing. You might be wondering how these factors influence sales. Well, that's where the element of uncertainty enters the picture, okay? As per Forbes, presidential races breed uncertainty in the housing market. They continue, why presidential elections affect the market more than any other election is simply because people fear change. Matt Laracy reports that whenever people get nervous, they don't make rational decisions. They make emotional decisions. All right, moving on. Something else you need to know about 2024 is how realtors are paid may be changing. In our current Texas real estate market, when a seller decides to sell his home, they have a few decisions to make. Okay, first they have to decide how much they'll pay the listing broker, meaning the one who lists the home for sale, right? Secondly, the listing broker will negotiate with the seller on how much of the listing broker's commission should be shared with the buyer's broker. The seller agrees with the listing broker how much of the listing broker's commission will be split with the buyer's broker. Paragraph 8 in the listing agreement between the seller and broker spells out how much of the seller's commission will be shared with the buyer's broker. There's no fixed amount, and it very well could be zero. Now, Texas is extremely vigilant with their antitrust policies, and in fact, it is a very large part of training to become licensed. They hammer it in over and over again that commissions are not and will never be a fixed amount. But whenever a property is listed on the MLS, there is a section to enter what the buyer's broker will be paid. Well, a verdict was recently given in a national lawsuit that has created quite the stir in the real estate world. Alexander Fabino has quite a bit to say on the subject, okay? He explains a jury concluded that the traditional practice where home sellers pay both buyer and seller broker commissions is anti-competitive. He continues saying sellers might gain more flexibility in determining agent compensations. While there's potential for savings if they no longer fund the buyer's agent's commission, it might deter agents from showcasing their properties. So if sellers no longer compensate the buyer's agent, what's the other option? Well, Fabino comments on that as well, saying if the commission structure is modified, buyers may find themselves directly compensating their agents, which could mean a rise in immediate costs. In response to this, FHA is already considering allowing buyer-broker fees to be factored into the loan. Now, I watched an interesting video recently where the speaker suggested an Uber-style approach where like an Uber, type driver could unlock homes for sale without offering any representation, right? Just like basically being like a door opener. And the first thing I thought about when I heard that, okay, is several times we have opened homes where a homeless person had moved in there. On some of those occasions, an aggressive dog was with the homeless person too. And realtors are trained with how to respond in those situations. I also thought about the many years ago where my mother-in-law had her jewelry stolen during a showing. Right? Realtors are supposed to accompany their buyers into every room during a showing to kind of mitigate that risk. Another thing that came to mind is Texas does not allow dual agency. And if you're unfamiliar with that term, it is when one agent, such as like the seller's agent, represents the highest interests of both the buyer and seller. In Texas, you cannot offer that form of representation. So lots to think about as we see the legislation and the appeal process pan out. You may be wondering what all of this means to us here at home in Dallas. Well, we always use a written buyer representation agreement, okay? We insist upon it. However, our commitment has always been that we will accept what the listing broker offers as payment in full. We know it's not fixed or regulated, but it's just something we've always committed to for our buyers. We never charge buyers any fees or compensation. Well, you can see this legislation would change that, okay? The buyer's broker should not assume the seller through the listing broker would pay them anything. When considering what the industry thinks, Fabino responded as follows. The NAR, or National Association of Realtors, signaled to Newsweek that it isn't ready to accept the decision without a fight. Fabino continues, Mantle Williams, NAR's VP of Communications, said the NAR would appeal the jury's verdict and reiterated the association's stance on prioritizing consumers and fostering business competition. So I think it'll be interesting to see how the Texas Real Estate Commission responds to this, because they've always been very outspoken about being antitrust. The Texas listing agreement already allowed the listing broker to not share any of their commission with the buyer's broker. They could just enter zero, but in reality, they almost never do. The buyer representation agreement already allows the buyer's agent to charge the buyer directly. It reads that the buyer's broker will attempt to collect payment from the listing broker, but otherwise the buyer will need to pay. So in theory, both agreements are set up to preempt any assumptions that require the seller to pay the buyer's broker. But still, I think it will be interesting to see how Texas responds. At this point, we haven't been directed to make any changes, and NAR is appealing the decision. So what does all of this mean for you? Well, going into 2024, you need to know this exists, and you want to ensure you always have a written representation agreement so you know exactly how your realtor will be paid and whether or not you'll be the one paying them, right? No one needs last-minute closing costs sneaking up on them and hijacking the whole home sale. In fact, if you want to be extra vigilant about closing costs, I actually did an entire video about hidden closing costs that you can watch right here. In the meantime, Wendy out.